Is the real estate market going to crash in 2023, or is it just going to be a slow, dull ache? Hi, my name is Adam Nadler. I am the owner of Vision Real Estate. Thanks so much for tuning in again. And if you haven't yet, hit that subscribe button and click the bell so you can get notified every time I put out a new video. And also don't forget to like this video so that it gets pushed out to more people like yourself. If by the end of this video you think to yourself, hey, you know what? I'd like to chat with that guy about real estate, feel free to click on the link in the description below. That'll connect you to a calendar where you can book a quick 15-minute chat with me at a time that is most convenient for you. Or feel free to just email me directly to adam@visionrealestate.ca any question that you may have, and I will send you a personal video response within 24 hours. Well, I'm no economist, but I know who is. Just last week, I was at a real estate conference and we had Benjamin Tal present to us. He is the chief economist for CIBC and he did an absolutely wonderful presentation. So I wanted to talk about a few things that he told us, as well as highlight an interview that he just did with the Financial Post. The first thing that I think is important to note is that in the battle to fight inflation, we have to recognize that inflation is a lagging indicator, not a leading indicator, meaning that the numbers that we're seeing for inflation right now are a result of actions that were taken months ago.
We had a situation in which home buyers got the benefit of a recession vis-a-vis extremely low interest rates without the cost of a recession vis-a-vis a broadly based increase in the unemployment rate. So that's really what led to the 46% increase in house prices during COVID. Now, when you look at the situation, we basically borrowed activity from the future. There was a sense of urgency to get into the market. We front-loaded activity, and the future has arrived. So what we are seeing now is not a crash, it's not a correction, it's not a free fall. It's basically reallocation of activity over time due to higher interest rates.
Which leads us to the next logical question of, well, what is a leading indicator? According to Benjamin Tal, it is the supply chain. Now, granted, we're nowhere near the level that we were at prior to the pandemic, but it is clearing up pretty significantly compared to this time last year.
The situation is getting a bit better, not great, but a bit better. What I mean by that is that the supply chain story is improving. If you look at the supply triggered inflation, the share of supply triggered inflation is going down. And that's good because the Bank of Canada can speak about inflation until they are blue in the face. They cannot do anything about supply chain issues. When it's going down in terms of importance, it means that the Bank of Canada has more power to deal with the economy because the effectiveness of monetary policy is rising. And that's more or less where we are. So the ability of the Bank of Canada, the Fed in the US, even the ECB in Europe, is starting to improve in terms of taking the economy down by raising interest rates. The effectiveness of monetary policy is improving.
Yes, a head of romaine lettuce is like $10 right now, and you can't find children's Tylenol to save your life, but it is still clearing up across the board as a whole. He gave us a bit of insight about how the Bank of Canada focuses on its battle to fight inflation and what historical mistakes it is trying to avoid. The first thing that he mentioned to us that they are looking to avoid is over tightening and raising interest rates too much too quickly. And the second thing that they are trying to avoid is loosening and lowering interest rates too quickly. So to go over the burning question of how much are interest rates going to go up and for how long, Benjamin Tal seemed to have a pretty logical response. He pegs the Bank of Canada going to 4.25% for the overnight rate. We're already at 3.75% right now, so that's not much more to go.
The Bank of Canada was given a green light by the market to go 75. They decided to go by 50 because they don't want to overshoot, and that's a good thing. At the same time, inflation is still there. It's not slowing down rapidly enough. They will have to continue to go. And the only debate is whether or not it's going to be 50 basis points or 75 basis points. Our call is that the Bank of Canada will end at 4.25, but I admit that the risk of the Bank of Canada going to 4.5 is not insignificant. The Fed, by the way, will go much higher. We see the Fed going to 5% because the effectiveness of monetary policy in the US is not as significant as in Canada because they don't have as much debt.
He mentioned that we could be seeing that number closer to Q1 of 2023, so over the next couple of months. But he also mentioned that they're going to hold things there for a while, up to about a year. Now, yes, we could see minor adjustments in the interest rate during 2023 as they respond to new data that's coming in, but they will be minor adjustments that are fewer and far between. At that point in Q1 of 2024, Benjamin Tal pegs the Bank of Canada starting to slightly drop interest rates by very small margins over a gradual period of time in 2024. So according to Benjamin Tal, we could see this housing market continuing to softly decline over the next few months and things start to pick up in terms of activity closer to the spring.
Interest rates will continue to go up over the next few months. The Bank of Canada is telling us they are not done. This means that this housing market will continue to soften. Now, the softening in the housing market has to be put in perspective. This is not a crash by any stretch of the imagination. The fundamentals of this market are extremely strong given the lack of supply. But over the next few months until the spring, I see the market continues to go down. And that's, by the way, a very good thing. That's a very good thing because after rising by 46% in 2 years, you need to reset, you need to slow down. And that's exactly what we're seeing. This is a very healthy situation.
Now, what does this mean for you? Well, if you've been watching my videos, you'll know that I'm a huge advocate of upsizing in a downward swinging market. You're going to get a lot more bang for buck, and that you should not be downsizing in a downward trending market. This is also not a terrible time to be getting your foot in the door. If you are a first-time buyer and you have a place to live, you can rent it out for a year while interest rates are high and then refinance once they come back down in a year or so. The rental rates right now are just through the roof. So I think that that also makes sense as a move if you are a first-time buyer. Just remember that you are married to your purchase price, but you only really date the interest rate. So there is going to be opportunity to play off that here over the next year. But that's just what I think. Let me know what you think by commenting below. Do you think Benjamin Tal is on the mark or he is way off the mark? Thanks for tuning in again, and I will see you next time. If you like that video, click the subscribe button on the right, or feel free to enjoy another video here on the left.